Gold slipped in recent trading, pulled lower by two familiar forces: a strengthening US dollar and Treasury yields that refuse to come down. Neither move is dramatic on its own, but together they create real pressure on the metal in the short term. Here is the basic mechanic. When the dollar gains ground, gold gets more expensive for buyers in other countries. Demand softens, and prices feel that. At the same time, when Treasury yields stay elevated, investors have a reason to hold government bonds instead of gold. Bonds pay interest, gold does not. So when you can earn a competitive return on safe government debt, gold becomes a harder sell. That trade-off is called the opportunity cost of holding gold, and right now that cost is notable. There is also the concept of real yields, that is, Treasury yields after you subtract inflation. When real yields rise, gold tends to underperform. Investors are getting a genuine return elsewhere, and gold's main pitch as a store of value loses some of its edge. A firmer dollar on top of that just adds more weight. Both of these moves tie back to the same root cause. Markets are still trying to figure out what the Federal Reserve is going to do with interest rates. Expectations for rate cuts have been shifting. When traders move toward a view that rates will stay higher for longer, yields tend to climb, and the dollar tends to strengthen at the same time. That combination has shown up repeatedly in recent sessions, and each time it does, gold faces a headwind. Now, it is worth keeping this in perspective. Gold remains near historically elevated levels. The short-term pressure from currency and yield movements does not automatically mean the longer-term picture has changed. Central bank demand for gold has been a consistent support. Geopolitical uncertainty has not gone away, and retail interest in physical metal remains steady. Those are structural forces that take a lot more than a few rough sessions to unwind. So what we have right now is a metal caught between strong long-term fundamentals and short-term friction from the dollar and yields. That tension is not new, and it is not resolved. For anyone watching the gold market, the key indicators to track are the dollar index and the direction of Treasury yields. If yields start to pull back or the dollar softens, that removes pressure from gold. If they hold or climb further, expect the near-term headwinds to continue. Upcoming US inflation data and labor market reports will likely be the next big input into that picture. Bullion Flash is brought to you by Absolute Bullion, a California-based dealer in gold, silver, platinum, and palladium. More at absolutebullion.com.